Hey everyone, how's it going? Good to see you guys. Hope you had a great day. Hey, for bro. Hey, Tim's. For what do you think about market profile and order flow? I'll answer that in just a moment. Hey, Peter, Spider Monkey from Were you always from Athens, Tennessee? I thought you were from somewhere else in Tennessee, but maybe I'm wrong. Wrong impression. See Fazio, Keys to Health. Great to see you. Appreciate your teaching. Oh, thank you. Thank you. I'm glad you're enjoying them. All right, so first question, first things first, so I can get rid of this slide. If you want to join my Telegram, it's thetradingpub.com/Kane. That'll direct you towards the appropriate Telegram channel. And again, I only have the one public Telegram channel, so if you get invited into anything else, then it's absolutely a scam. All my private Telegram channels, you will be sent a link via a members area, and then you can click in and join it. So anything else is a scam. If you see videos of me asking you for money, asking you for crypto, it's a scam. Okay, I will never do anything like that. So now that we've got that out of the way, we can take a look at your questions, and then I will start taking a look at the markets. Oh, you're normally from Ohio. Oh, okay, so you're just visiting Athens? So question was, what do I think about market profile and order flow? So it sounds like Forbro, are you mostly a day trader? Because I think you mentioned that the spider lines that you were talking about a few days ago, those are mostly a day trading tool. Market profile is mostly a day trading tool. I prefer volume profile versus a market profile. Market profile just it's like for every, if I remember correctly, for every X number of minutes that it stays at a price, then you get the bar increases versus the volume of shares that are traded at a price, the bar increases. So basically you're saying how much time is a market spending at a certain area versus how many shares are being transacted in a certain area. And they might seem like similar information, but time, if you have very low volume, if you have a penny stock, it's going to stay at a price forever. It could stay at the same time for days, and it's not going to really be meaningful information. So it's a lot more meaningful to me as a trader to know where the volume is transacting, not the amount of time that a price stays somewhere. So I prefer volume profile over market profile. And then order flow. Order flow can be, it depends on what kind of order flow that you're looking at. Because orders can be pulled, right? So if you're saying, hey, I'm looking at level 2 data, well, level 2 is the highest bid and the lowest ask. So that information will be accurate. But if you're looking at level 3 or level 4 data, or you're just saying, hey, this guy just put in an order for some really big amount and it hasn't been filled, that's not very useful information necessarily, because that bid or that ask could just be pulled away once the price gets close. But if you're saying that something actually transacted there, right? Someone went above the bid or above the ask in order to get in, or below the bid in order to get out, that can be useful information depending on the size. But also, it's very difficult to know the context of that. You don't know if they're hedging, if they're rebalancing their portfolio. Portfolio managers spend over 90% of their time rebalancing their portfolio. So just because you see an order or a large order, it doesn't necessarily mean that they're taking a position. It could just be a large institution rebalancing their portfolio. And the other thing that to be aware of when you're looking at order flow is that that what we think of as size, oh, $8 million, that's a huge size. Not if you're a $1 trillion institution, right? So it doesn't necessarily give you really useful information, but it can. There's definitely people who use order flow very effectively. I haven't spent my time on order flow, again, that is more of a not necessarily day trading, but it is a style where you're going to be looking at your screen, waiting for those orders to come in and constantly filtering. And that's not really what I do, because I manage so many strategies and I'm looking at so many different things. I can't just bird dog one little area and just keep watching it for opportunity. So I have to rely on different methods where there's more leeway where I can flow from one to the other and not feel like I'm going to miss out on some information. So order flow, you gotta really know how to read it. It's sort of like reading a tape. You gotta really know how to read the tape in order to interpret what is useful information and what's not. It's not as simple as people think. It's not like, oh my God, we see a big order here, and then let's go and buy and let's go or sell and follow along that order. It's not that simple. Spider Monkey is in Tennessee on business. Great. Okay. Awesome. So let's take a look. Yesterday, I forgot who was asking me. Someone that started with an S was saying that, oh my gosh, the market felt like it was dropping quite a bit yesterday, and I commented that in the context of things, it was just chopping sideways. And you can see today we continued that chop. We did touch the EMA8. Excuse the bell. We did come and touch that EMA8 and sort of bounce off of it. But remember what I said, that it's probably, for at least until we get to Thursday or Friday, we're probably going to get inside bars, meaning the high of whatever day we're on, so tomorrow, high is still probably going to be lower than Monday's high, and the low is still probably going to be higher than Monday's low. So what that means for us, though, is that it's starting to get kind of squeezed, right? There's not that much more room over here. If we keep following that EMA8 up, and then it's going to get squeezed up. It's going to be a smaller and smaller range that it can trade in, and eventually it's going to break something. Right now, there is buying pressure in the market. So yes, the more likely direction is at the moment breaking up, but again, I don't think it's going to be tomorrow, and probably not even Thursday. So we'll say maybe not even Friday. We are building pressure to the upside though, and so we'll look for. We should be leaning bullish in this case in our overall portfolios. So a little bit later on, I'll take a look at what areas would I be looking in if I'm looking for bullish trades. But again, not like super bullish. It's not like we think we were going to go screaming higher. It's just probably we're leaning bullish, so we could take neutral trades as well, or bullish to neutral, neutral to bullish trades. So yesterday we talked about that vertical spread that could do well in a neutral stance, and also do well if it continues to go up. We took a look at Newmont Mining. Let's take a look at see how that did great today. It just continued to go higher. So we chose a 67-69 spread, and that would have done great. Although the low, it didn't pull back. So what I gave you was, hey, if it pulls back and we could get into that spread at $1.40, I think it was, then that'd be a great opportunity. It went flat, so you might have been able to get in at I think it was $1.56 when we were looking at it after markets. You may have been able to get in at that price and take advantage of this, but otherwise, if you put it in at $1.40, you would not have been filled. But it demonstrates the principle, right? We're looking for something that is, we don't want any risk to one side, right? We believe that it can go higher. It could also chop sideways. We want to take advantage of that, and so our risk of being wrong, or risk is in the direction of being wrong. And so if we're wrong and it comes down below this level, well, we still have a margin of safety, right? We still had $2 of wiggle room, right, where we could still be safe. But that's a demonstration of that. So we'll look for more of those types of opportunities later on today. Hi, Maggie. And let's take a look real fast on what gamma is implying, both for the markets and what, not just today, intra 0DT, but also going forward, because that could help us get a clue as to where at least market participants are believing where this market is going to go. So the Telegram channel, in the Telegram channel this morning, I sent out pretty early. I gave XSP this time. Are you guys just seeing black? You're not seeing a chart, right? Because I'm just seeing black. That's a. I don't think, well, I can't see it. Maybe you can see it if I don't zoom in. So over here, basically what I said is that range, we're still range bound. Gamma is still implying a range bound. We're looking at 439 to 645. Yeah, it was a black screen, yeah. So I felt that we would bounce in between 639 and 645 as sort of a large-ish range. And then over here in the, I can't show it to you, the SPX, it was the 6440 to 6470. And then the XSP showed a bigger spike right here, right at 645 on XSP. Remember, XSP has similar levels to SPY, so it can be kind of confusing, but 645 on XSP. Now, XSP is a little less reliable though, because there's a lot less volume being traded in XSP than there is in SPY and SPX. So I took that one with a grain of salt. If we take a look at where we traded intraday, let's see, we're at the low was 641.5. The high looks like is about 645.5. So that 639, 647 range was just a little bit wider than where we traded. So it was a pretty good range. And then on XSP, we ended up at 646.5. Last few minutes though, it really started running away from that 645 level. But again, the XSP is less accurate. So that's why I wasn't giving it out to people before. But I don't know if I'm going to continue to give out XSP or not. It's not, to me, it's not super useful. And then SPX, what did we say? We said 6440 to 6470. And look at SPX, that's pretty good. SPX pretty much nailed it. 6440. 6440. Okay, so on the low end, it did go a little bit below that right at the beginning of the day, but I didn't send that out until a little 709. So over here. So we were already right at 6440 when I sent that out. And so we got a pretty good range. Gamma gave us a really good range today. So if you did a neutral trade, if you did like an iron condor, for example, around any of those trades, then you would have made your maximum profit. Okay, so let's take a look at what Gamma is implying for the overall markets. Okay. And hopefully that'll load up. And then I lost my chat. Let's see what you guys are saying. Hi, Kevin. When you do 0DT neutral strategies, is there criteria other than Gamma like internals? And what's the latest you would determine to go into neutral strategy? Good questions. Internals, I don't care too much about them when I'm putting on the trade, because I'm generally putting on the trade about half an hour to an hour after the market opens. So I need to have a good level. So those internals are going to change throughout the day. And so if it's a bullish day, you're going to watch it go more and more bullish. If it's bearish day, you're going to watch it go more and more bearish, unless it's a gap open, right? It's a gap open, then those internals will show you that it gapped higher, so everything's super bullish, and then it gets even more bullish or just stays sideways. Or those internals will say, oh, the bullishness didn't last, and then you start moving downwards. So, but a lot of that, I'll get a clue that will happen based on the Gamma levels. I'll already know that that's going to happen. So the internals, if I'm going to watch the internals, then it's going to clue me in as to whether or not my trade is going to get threatened. And if my trade gets threatened, am I going to defend it? Am I going to modify it? My personality as a trader, and what I teach you guys is that if you're wrong, you're wrong. Just admit it. Okay. For me, there's no such thing as repairing a trade. Okay. There's no such thing as saying, oh, I'm going to throw more money and try to adjust and widen my range and maybe I'll be right. My premise was wrong. I'm not going to then. So if I want to act on new information, then I'm going to close my old trade and open a new trade. And net, out of those two trades, I might still become slightly profitable. That's possible, or I reduce my loss. Or if I really really sucked it up that day, then both of them end up being total disasters and total losses. But that's pretty rare. What I don't want to do is get into the attitude, the mental attitude and the emotional attitude that, oh my God, I was wrong. I can't be wrong. I can't lose money. I can't stand losing money. And therefore I'm going to try to fix this trade and fix this trade and fix this trade. And then you end up being either barely right, you barely making a little bit of money, or losing less money, or maybe losing more money. To me, that's not a good reward risk ratio. Okay, so if I'm already down, say 30-40% on a trade, and I go rescue the trade, maybe the best I can do is maybe make it a positive 10%. I'm not going to be able to rescue a trade that's down 40 and turn it into a 200% winner, right? That doesn't happen. So I might be able to take a 40% loser and make it a minus 10% loser. So the reward risk is just totally off. If the best I can do is make it a 10% winner, then I'm risking. Now I'm already down 40%, I'm throwing more money at it. So maybe I'm risking another 20, 30, 40% just to maybe end up positive 10%. That's a bad reward risk ratio. So I don't try to repair my trades. I will admit that I'm wrong. And then if I want to, I will take up a new position based on the new information that I have, if I feel like I still have a really strong edge. But in day trading, often what happens is there's not that much time left in the day. By the time I figure out I'm wrong, a few hours have passed, and then there's not that much time left in my trade. So even if I feel like I have good information now, the reward profile isn't there for me anymore because there's only a few hours left. So generally in these 0DT trades, I just take the attitude, if I'm wrong, I'm wrong. I sized it so that I could take 100% loss. I sized it so that I could hold it all the way to the end of the day and end up being wrong. Or if I really figure out super early on that I'm wrong, then I'll just close it for a smaller loss than would have happened if I traded all the way out to the end of the day. In which case, that's when the market internals might be useful to me. It's like, oh, this situation changed. But if the situation changed, most likely I'm also going to see it in the gamma levels, not just in the market internals. You'll see these bars, they'll shift around and they'll move. And so sometimes you'll see me post 2 or 3 times in the day instead of right in the morning. It's because gamma shifted. Or if gamma doesn't shift, it's rare that I will say something later on in the day. But every once in a while, like I think last week or the week before, things were shifting quite a bit. Let me see, maybe this day? Yeah, so okay, like this one, it didn't shift a huge amount, but if we look right here, I said SPY. So the original SPY said implied negative skew down to 635. And then later on, we got some gamma back in the higher areas. So we still had that 635, but instead of thinking that it might go down to 635 and stick, we thought, well, now it might bounce and go choppy and go between 635 and 640. Okay, so which day was this? This was August 20th. Is that right? August 20th? I think, yeah, August 20th. Let's see what that looked like on August 20th. Okay, so August 20th, we said, okay, lower level of 635 And then so it actually did trade down to below that, 634, 633 and change. And then after that, we said, okay, well, now we have some positive gamma exposure. So we might just chop now, somewhere between 635 and 640. And so actually it did chop, but actually around 636. Right? So you'll see the picture develop and change in gamma as well as in the internals. Right? So hopefully that answered your question and was helpful. For your info, I trade XSP flies most day. Not sure how others trade XSP. Okay, yeah, I traded a fly today. I traded a fly yesterday as well. My XSP fly today barely lost money. Well, it lost like $8. Okay, so why? Because I decided to center. I felt that based on what I told you guys in the morning, that we would have chop. And I said, okay, maybe that chop will center around might center around that 645 level. And so I centered my butterfly around 645, which actually, again, until the very last minute was perfect. All right, 645 was great, 644, 645. And then that last half hour, we just really traded up to 646.59. My break even was 646.51. And so I lost a tiny little bit. So the reward risk ratios on butterflies, if you structure them correctly, are really, really good. Because even if you see the maximum risk, the possibility of you hitting that maximum risk is generally very, very low. So for me to hit max risk, this would have had to trade for max loss. This would have had to trade all the way up to 650. And that's not going to happen today. That'd be all-time highs again, by more than just a few points, right? It would be by over $2. It would have been all-time highs. And then to lose on the other side, maximum risk, it would have been below 640. So today, given how choppy we were, there's never at any point was I risk of losing the maximum. And so I ended up losing just a tiny little bit for the possibility of making quite a bit. So I like butterflies a lot because generally they offer the best reward risk ratio. If you can get a good level if you have a good idea of where you believe that the asset is going to end, or you don't have to hold till expiration. I could have closed it right here or right here when it returned to about 645, and I would have made about 40-50%. Okay? I didn't because I didn't want to take a day trade in the account that I was trading in, which is a little silly because the account is over $25,000. It doesn't really matter. But the attitude that I'm taking with that particular account is a very hands-off. So I can babysit other accounts, and then this one I can just take a hands-off approach. And on average, it'll take care of itself because the reward risk of the trades that I'm taking in that account are really, really good. So it doesn't matter that I took a baby loss over here because maybe tomorrow I will make it a 50%, or the next day maybe I will make it 80%, and then maybe I'll make 150%, and that baby loss won't mean very much. Okay. Don't throw good money after losing. Yes, exactly. Yesterday, did you indicate that you do credit positions on flies? I was told never to sell flies. Okay, I don't know why you were told to never do so. So, in general, okay, if you're doing an iron butterfly, which means that you're doing combinations of puts and calls, then yes, you're doing it for credit, just like an iron condor. Now, it's defined risk, so there's no reason to not do it, right? There's not like you're exposing yourself to infinite risk. Like if I said, oh, never short a straddle, okay, I could see that because you have infinite risk on either side. If it doesn't stay in your little range, then you have infinite risk. You see how this looks very similar to the butterfly. The difference is that a butterfly will hit a maximum loss and then go go horizontal. It'll hit a maximum loss and go horizontal. Whereas this straddle will just keep on going down forever and ever and ever and ever. So I can see people saying, hey, never short a straddle or a strangle, but never short a butterfly seems weird to me. Okay, and if you go long a put butterfly or a call butterfly, then you'll get a very similar structure, except you're going to do it for a debit instead of a credit. There's no reason in particular to not. So I could choose these. Okay, let's see if I do let's do the same thing. If I do SPY and I do it out to August 29th and I do 645, 640, 650, you see that? Okay, and then max profit 371, max loss 129. And then if I do the same thing on an iron butterfly, you're going to see basically the same thing. All right, are these the same? 646, okay. Yeah, 379, 121, right? 379, it just within a couple dollars. It's basically the exact same structure. So if you wanted to avoid the credit for whatever reason, then you could just do a long put butterfly or a long call butterfly. You'll get this basically the exact same result. Personally, my general rule of thumb is if I can get the exact same structure, generally I will do it as a debit rather than as a credit. Why? Because then everything is in the same direction as almost all of my other trades, right? Generally, I am buying to get into a position. So if I buy a call, then I'm buying to get into a position. I'm not selling to get into a position. And that means everything that my broker is reporting to me all stays in the same direction. So I don't have to go, oh, is this one a credit? This one's a debit. This one, they're all debits. Or when it reports the P&L to me, it's more accurate because it takes my max loss and however much I've gained divided by that max loss. Versus if you do it on the credit, then it takes your however much you've made so far over your credit. So basically, if you make full credit, it tells you made 100%. But in this case, if you made full credit, you should have made versus your risk, your return on risk which is far more important. Way. Like I don't care how much of the max gain you made. That's a meaningless measure. It's a meaningless stat. It's like if you're following baseball and they report to you the heart rates of the audience, like who cares? Maybe if you did the heart rate of a certain player, that might be sort of relevant, but even that, no one really cares. They just care, did he hit a home run? How many swings is he taking versus how many that he actually hits, right? Those are the stats that actually matter towards the score, right? So that when you do a credit, then the way that the broker reports to you is completely meaningless. Those stats become really meaningless. But if you'll do it for a debit, then you'll know actually I made this much for this amount of risk and versus this amount of risk. So it actually becomes a useful measure. So generally I do favor debits, but in the case of an iron butterfly, there's no reason, there's no like, oh my God, it's a terrible thing to do an iron butterfly for a credit, to do a butterfly for a credit. You must not ever do it ever. No, there's no reason for that. But there are good reasons to sort of avoid them, just for the way the broker reports to you and for the sake of your own management, but there's nothing fundamentally wrong or risky with taking a credit on a butterfly. Can you show the butterfly setup? Sure. Which of this particular trade? Why don't you go ahead and set your target? You wait until the end of the day. I'm not sure I understand your question, Tim. So if it's a neutral day, if I believe it's going to go back and forth, then all I care about is the range. Okay, so do I believe that this is going to stay between 641.21 and 648.78? And if my gamma structure suggests that it will, then I'm good with this. Then I'm good with this, these spreads. Otherwise, I'll adjust them so that the break-evens are very similar or outside of what the gamma suggests. If I get a good gamma level where I think that it could pin or at least head towards that direction, it's been a while. We've been in mostly choppy markets, but let me see if I can find a good example of that. Okay, yeah, so on this day, August 12th, we had a pretty good idea, 642. Okay, so let's see. So then I could target 642 on August 12th. Yeah, August 12th. So what I would do at that time is that I could center my butterfly around 642, and then how wide do I make it? Well, just make it as how far off, how much wiggle room do I want it to have? So again, I'll look at my break evens, not my strikes right here. Let's say I was comfortable with 640, so $2 plus or minus, okay? So it would be 640 and 644, and if I look at this, then that's way too wide. Okay, and that's pretty good. So these break evens are a little bit wider, so this is a little bit more safe. And look at this huge reward to risk ratio right here. So if I nail it at 642, then I can make $270. And if I'm way off and I'm just completely wrong, the most I can lose is $30. That's a 9-to-1 reward risk ratio. That is really, really, really good. Of course, this is not 0 DTE. This is a couple days out, but this is just as an example. Okay, so same principle, 0 DTE, it won't be 9-to-1. It'll maybe be 2-to-1. Maybe it'll be 3 or 4-to-1. Maybe it'll only be 1.5 to 1. But in any case, it should be quite favorable in terms of the reward risk. And then I have good reason because of gamma or maybe a couple other things as well of believing that we could pin very close to 642. So let's see what happened on August 12th. August 12th, we ended at 642.65. Not bad. Not bad, right? That's pretty good for half an hour into the market session. You got a really good idea of where it was going to close, right? Within, was it 60 cents? I forgot. 62? 65. Okay, so in this case, if it ended up, again, pretending this was 0 DTE, if we get 642.65, we would have made $204.64 on a $30 max loss, right? That's over a 7-to-1. So that's like over 600% gain on that. Not bad, not bad at all. Okay, so that's better than if I just bought a call early in the morning. If I bought a 0 DTE call on that day, right around 7. Oh, actually, that would have happened to be around the low of the day, but that's that would have been a really nice gain too. But it would have been 700%, right? It would maybe 200 or 300%, but not 700%. Okay, so that's why I like. And then if you're wrong on that 0 DTE call, if we're wrong and it went down even a little bit, then that would have been 0, right? So it's 100% loss versus this, right? I'm only risking $30, where here it was however much that call would have cost. Okay, so I like those butterfly structures quite a bit. Of course, there's 4 legs to them. So you're paying for 4 contracts instead of just 1 contract. So if you're paying really high fees through your broker, then it might not make sense. If you're making only a little bit, like if you only make like 5 or 10% on that day, then a lot of that is going to be eaten away by your fees. But if you're making 600-700%, then you're not going to care about your fees. Okay. Credit fly, does that require more margin? No. Margin is always maximum risk. Okay, so over here, if I set up the exact same thing, August 29th at 6:42 and 6:39 and 6:45. Okay, if I set up the exact same thing, then what will happen is this one is a debit, the max loss is debit. So I'm only going to use up $32 of buying power or $32 of margin. Over here, my max loss is 30. I'm only going to use up $30 or $30 of margin. Okay, so I'll show you that. I will show you. Okay. So if I do an SPY and I do a August 29th and I do an iron butterfly centered around 6:42 and I buy 6:39 and I buy 6:45. Okay, that's my, okay, taking $2.70 credit. That's what we just saw right here. Okay. So what I'm telling you is that your margin requirement will only be this $30, okay, the max loss. So if I go confirm and send, then what we see is the buying power effect is that 30, well, plus fees, right? So $32. Okay, that's it. Okay, that's all it cost me in margin. That's it. It's always your max loss. It's always your max loss. Okay. Oh, you're welcome, Maggie. Glad you found that helpful. And you too, Peter. Okay. How are your developers doing with the Gamma website? It's coming along. It's coming along. I'm pretty excited. It's going pretty well. Let's show you guys some examples. Okay. Well, actually, before we do that, I said we were going to take a look at the gamma structure inside the S&P 500 or SPY. And because what I want to see is what is the market expecting for the S&P 500. So what I'm seeing here is that there is a big amount of exposure right here at 650. So it's going to be difficult for us to get beyond that 650, or at least we're probably not going to break straight through it. We're probably going to reject it and then maybe retest it a few times and then break out. And if we can break out, this market is expecting this to go higher all the way up to, so this is what we call a stair step, right? So this is long, next longest, next longest, next longest, next longest. This is a nice little stair step upwards. And I'm going to get them to flip this around because it's a little bit easier for me to interpret, especially over here. If you, oh, they did flip it around. Nice. Okay, thank you. These guys are pretty fast. I'm very, very pleased with them. So what we see is that we have this, let me see, G ink. Let me see if I can draw this. Okay, so it's like, it's kind of like this. We're climbing stairs. And what we should see is that once we get past a gamma level, then this will start to grow. And then when we get past that, then this will start to grow. When we get past that, this will start to grow. And then, so basically we have a stair step all the way up to 700. Okay, how far out does that go? Probably the end of the year. It's not anytime soon for sure, but I can confirm that using the tool by looking over here with my expirations. So we have a lot of expirations out in September, not so many out in December, but what I can do is instead of looking at all expirations, I can see, okay, if we go all the way out to December, what does that look like? So they're working on the speed, but it's calculating a lot of stuff, right? So I told you guys in my original software, this is why it took me a long time to crunch, because this is even way faster than my original software. To be able to thin slice like this, my original software on average took about 20 seconds per ticker, but that was on like one static view. I couldn't keep dynamically changing the view like I can over here. So out to December, what we're seeing is that there are people positioned all the way out to 700. You see that? That's probably where most of the 700 is. There's a lot at 680 also. So this market is expecting to go even higher towards the end of the year. Now, of course, we do see large gamma exposure down here also. And it kind of makes sense because people cannot be all that certain by the end of the year if we're going to go higher or lower. And so it makes sense that we have large gamma exposures both above and below the current level. Now that's December, right? That's December. But what we're saying is what we saw earlier was that when we netted all of this out, when we go across all expirations, then a lot of that negative gamma down here was negated. Okay, so over here, I guess it's probably easier to see. So down here, we do have a good amount of gamma right here, but there's a lot more up here than there is right here. All right, so this is encouraging, right? This is encouraging that basically the market is positioned right now bullishly. Kind of like what I was saying, that, hey, we are more likely to go up from where we are right now than we are to go down. And the market is positioned that way as well. Market participants in the options market are positioned the same way, and we are seeing a more likely move higher, and then some preparation or maybe some hedging towards the downside. Yeah. Cool. So that's how we use that's how we interpret for the overall markets, and we can use it to scan, or we can use it to look for opportunities, or we can use it to look at our favorite stocks. Why don't we do it that way today instead of scanning? Why don't you guys tell me some of your favorite stocks and we can see what gamma says? Or maybe you're in a position and you don't know what your target should be. We can use this to help determine what our targets should be as well. So you guys give me something. Give me a couple of symbols and we'll play around with this and see what we can find. Okay, and the most important thing to remember is that we take everything in context. Okay, so it's not just like, oh, there's gamma here, let me trade it. My whole point in doing post-market reviews, you always see me go in context. This is what the S&P is doing. Sometimes we take a look at what dollar and bonds are doing, and then we take a look at the sectors. We get everything in context, right? So let's see, MP, okay. We'll take a look at MP, at Apple, at Meta. Okay, so the first thing I'm going to do is I already have my picture of the SPY. I believe it's going to chop sideways for a couple more days, and that there is some upward pressure. We could break, if we're going to break in one direction, it is more likely at this point to break upwards than it is to break downwards. So if I'm going to look at MP, then MP is also a bullish signal. And then it pulled back to its EMA 20, started to bounce, faltered a little bit today, but overall it looks bullish, looks like it could continue to move upwards. So now I want to know, what does gamma think? Do I have a compelling reason for the market maker to add its buying power to push this upwards, or does it actually have a reason to pull it back down, maybe back down to the support level over here? So we're going to take a look at MP. in MP, it is telling me that a little bit higher, right? We got gamma above. We got a good amount of gamma above at 75 and 80. We've got a good amount at 70, so basically right where we are. So basically what happened today is it traded back down onto a gamma support. Let's see what that looked like technically. Okay. These zoom zoom controls are right on top of where I need to grab my window. So, okay, so 70 is right at support. So we chopped around this support. Looks like that support is holding and it went upwards. We traded back down to kind of close to it, but that's support right there in gamma structure. If it breaks that support, then it does have a compelling reason to maybe test 67. And if it breaks 67, then we have a gamma flip right here. Gamma flip means if it goes beyond there, it's probably going to accelerate in that direction towards whatever. And that whatever is this gamma pocket right here, which is also its the max pain. Max pain means that the market maker is going to be really trying to covering their butts if we get down to 60. So if we have support at 70, we have support at 67. If that breaks, then at least from a gamma perspective, we are probably going all the way down to 60. Now let's see how that matches with technicals. Okay, 60 is right here, this flat area of support over here. Okay, so it matches up pretty well. But now more interesting to us because the market is bullish, this sector, metals, is bullish, and this stock is bullish. So we're actually more interested to the upside. So it looks like we have upside to 75 and 80. The 80 pocket is smaller? Is smaller. Okay, yeah. So 75. So we have a pretty clear shot to 75. If we can get past 75, then we've got 80. And then if we can get past that, we've got 85 and 95. Those are looking further down the road. I'd be focused on this 75 first. And so where does that line up with over here? 75 is right there. And so basically near the area of consolidation when we hit these highs over here. So it looks like the market definitely feels, and it could get the support of a market maker to return to this area of support. And if it can break above that, then we can hit 80, 85, and look, was it 95? Yeah, 95. So this can have legs. So this is a compelling and very interesting opportunity because it so happens to match a couple other criteria, right? So remember, context, your trade idea has to, it doesn't have to, but it is much stronger if you can pull in a lot more elements of it. So far we said the S&P 500 is neutral to bullish. Metals sector is very strong and bullish. MP had the news that the government is investing into it, and so that is bullish. Technically, it is bullish. It pulled back to the area of support and bounced. It pulled back to the area of support in gamma, and so far is bouncing. And then what else do I love to talk about in the post-morning show? Long-term trend as represented by the MA50, and then the shorter-term trend as represented by the EMA8 is doing what? It pulled back to against the trend, and now reverting to match the trend. That is really not easy to see color. Okay, so just yesterday, or a little bit, maybe today or yesterday, it started to revert to match this longer term trend. Excellent, excellent entry point. I love it. This looks like a great buy with a initial target of a 75 gamma pocket. Okay, but we also have an 85 gamma pocket. Come on. And we also have a 95 gamma pocket. Okay, and then how long can we expect this? So number one, what's the expiration of all that 75 exposure? That's how we would take a look at this. Okay, so it looks like we might have some, this doesn't tell me the exact strikes, but the major drop-offs are this week and the monthly. Okay, so I'm gonna look at those. So if I remove all but this Friday, okay, so it does look like we could get to that, potentially to that 75 by this Friday, but maybe that 73 is just a little bit more likely. But 75, maybe this week, maybe. I wouldn't say super strong, but if I go in and add in the following week, even stronger, compelling reason to believe that, yeah, it could hit that 75. And then I just want to see if at any point 75 drops off or a higher gamma takes over. Okay, so far, still 75 that far out. Then we'll go out to mid-September, the monthly. Okay, now 80 is really starting to compete here though. Okay, so it looks like within the month, we have compelling reason to believe that we can make it to at least that 75. Okay, and then the other way that I like to do it is that I will estimate how far we are in terms of ATRs. So if I wanted to get to 75, and right now we're at 69.83, then we are 5.17 away, and my ATR is 4.84. Okay, on average in the S&P 500, now this is an S&P 500 stock, but the average for S&P 500 stocks is probably reasonably good for any mid to large cap stock. So I can reasonably expect that one ATR can be done in about 3 sessions. Okay, 3 sessions would take us to the end of this week. So it is possible for us to hit. It's not unreasonable for us to believe that this could get hit by this Friday. If I wanted to be just a little bit more conservative, I would say by next Friday. Okay? So if I take an entry here, then I could plan on it potentially hitting 75 by next Friday. So now I have a good idea of what if I wanted to do a single, or basically my execution. Well, what expiration do I want? Well, that's going to depend if I do a debit spread, a credit spread, if I want to buy a simple call, if I want to do a butterfly. But now I know I'm targeting next Friday, so a week and a half from now. So if I want a single call option, and unless I'm going to go fairly far in the money, then I don't want to choose next Friday's expiration. I want to give it even more time. I probably want to choose, at the very least, another week or maybe 2 weeks further out in terms of my expiration. If I want to do a credit or debit spread, then I want it closer. I want it to expire very close. So I would choose next Friday as my expiration if I was going to do a debit or credit spread. I know you asked me for a lot more tickers, but I think it's more valuable if I finish this and take it to its conclusion, like say actually to execution and maybe a little bit of management. And then if we have more time left over, I can go look at the other stocks. Does that make sense? Is that valuable to you guys, or was this good enough and you want me to do the same thing on the other tickers? NVIDIA earnings will determine whether we break up or down. It can if there's a big shock. If NVIDIA earnings are just in line and just moves a little bit, then the market will just keep on chopping sideways. Yeah. NEM, EXP, and SHLS, Dollar Tree. Does it impact your analysis that MP recently hit the 75 target? A little bit, yeah. So we already hit it. So that's a great question. That's a great question. So what we see is that in this timeline, we actually hit 75 already. So it already got attracted to it and then it pulled back. So what's important to me, if we hit it recently, then I want to see it pull back to another area of support. And it did. It came back to this 70 strike support. Okay, it could go all the way down to this 67 support, but that 70 strike support is pretty strong. So I'm pretty happy with the retracement already. And so the probability of it bouncing from the support back to the 75 is pretty high. So that's a great observation. Very, very, very good observation. Yeah, and also technically, we saw that happen as well. So over here, yeah, we hit 75 recently, and then we pulled all the way back down to the EMA 20 and we bounced. So the fact that we bounced gives me confidence that we're going to go and revisit to the 75 gamma pocket. If we hadn't bounced, then we say, okay, well, where's support? Where's support? Where's support? You know, where are we going to find support? And then we see a bounce, then we would be looking at that 75 gamma. But since it already bounced off of this EMA 20 and off of that 70 gamma, then that's why I'm okay with retargeting that 75 gamma pocket. Great question, great question. This exercise is so useful. I would like to continue tomorrow in choosing. Yeah, okay, great. We can do that, yeah. Okay, please continue, please. Okay, great. Okay. So now we've got a couple of things here. So now I will show you if I'm just going to do a simple call, if I'm going to do a debit vertical. Credit vertical is going to be the exact same thing. The debit and the credit vertical, they're going to be structured the exact same way. Mathematically, they're going to behave the exact same way. So there's no point in going through both of them. I'm going to choose the debit for the reasons that I explained at the beginning, which was that I want all my trades to be in the same direction because it just makes management so much easier. Plus, I don't have to worry about assignment if I'm doing a debit spread, or I have way less concern. I can't say that I don't have to worry about assignment, but the possibility of me getting assigned is far less than with a credit spread. So I'm going to show you in terms of a debit spread, and then I'll show you in terms of a butterfly, and then we can track all three trades. So let's start out with option strat. Let's start out with a simple call. No long call. We're looking at MP. And actually, I guess I should look at an option chain before I go to option strat. So let's go to MP. And we believe that it's possible that we could reach that 75 target by the end of next week. But I want to give 1 to 2 weeks extra because I don't want to get killed by time decay. I'm less concerned about that in a spread because I'm buying and selling time decay in a spread. But here in a single option, time decay is a concern. So I'm going to go look at 12th of September. I'm going to look at 19th of September. I'm going to see how liquid things are. Things are reasonably liquid on the 12th. Things are same amount of liquidity in terms of bid-ask spread on the monthly. So there's no particular advantage to go to the monthly. So now I have to decide, do I want to go at the money? Do I want to go out of the money? Do I want to go in the money? So I will almost never go out of the money. The most I will go out of the money is about 40 delta, because that is an efficient move. The change from the gamma change from that you get from a 40 delta up to a 50 delta, then a 50 delta up to a 70 delta, that is a steep curve, which means that your prices will move up more quickly in that delta range. But I'm always considering the risk at the same time. And so that's why I rarely go out of the money. I'd rather go at the money or in the money a little bit. And generally anywhere from 50 delta up to 70, 75 delta is generally pretty good. I also like to take a look at extrinsic values. I don't like to pay too much in extrinsic value. So over here, what would I look at? say anywhere in this 65, 66, 67 range. The thing is though, we're expecting this to move pretty quickly. So I don't have to go too far in the money. So let's say if we reach it by September 5th, okay? We reach that 75. Okay, what are each of these going to be worth? Okay. And so I want something that moves fairly efficiently. So I'm going to go closer to at the money. If I bought myself more time, I would go further in the money. But right now, I bought myself very little time, right? Basically an extra week after where I expect the target to hit. So I'm going to go closer to at the money. And I'll probably pick, out of all of these, I'm going to start looking at the bid-ask spread. So this is $1.20. I'm definitely not picking this one. Okay. This one is 30. This one's 30. This one is 30. This one is 20. So I'm going to do the tightest one. So I would either do 70 or 71. In this case, I would be slightly more conservative, and I would pick this 70 strike. 70 strike, go in for about $4.30. It looks like, according to pricing model, that it could, if it reaches 75 by next Friday, then this would be priced somewhere around $6. So then I get an idea, 6 divided by 4.3. Okay, I can make about 40%. Not bad. Not bad. Not amazing, but not bad. Okay. So let's go over here, and I'll say, okay, I want that 70 strike call out to September 5th at why does it think it's $3.20? Oh, sorry, September 12th. September 12th. Yeah, so I'm going to save this trade. So that's one way I could execute on this trade idea. Okay, next, what can I do? There's a couple of debit spreads that I can do. The first one, super easy, is basically just straddle the at the money price. So if I go 69.70, okay, because we're at 69.78, so I just round it down, round it up. $69, $70. But this time I'm going to go out to September 5th because that's when I expect it to hit. I don't want to take extra time because in a vertical spread, time, the faster we can, or the more we get into this max zone, the more it is in my favor. Okay, time, the faster we go in here, if I have a whole bunch of time left over, I'm not going to make as much money. Then I just have to sit on that trade forever until it expires in order for me to make my maximum. So whereas if we only have a little bit of time left, that price movement upwards makes a big difference. I make money really fast. So speaks to the efficiency of my money, the efficiency of return. So I would just go over here and I would just say, hey, look, I can make 100%. I can make $50 or I can lose $50. So I got $50 at risk. I can make $50. That's a 1-to-1 reward risk ratio. For all the reasons that we are going into the trade, we believe we have a much better than 50% chance of winning this trade. So this is a very highly positive expectancy trade. And so this is a great trade. As long as I'm willing to lose that $50, or I'm willing to lose however many contracts I end up doing, however many lots I end up doing, I understand that I could experience 100% loss, and I'm okay with it for that possibility of 100% gain. So that this would be another way to express it. And again, I don't want to go out to December 12th or 15th or even longer, because my plan is to try to capture all of that because my edge is compelling. My edge is much greater than 50%. And so I'm not going to try to cut this off short. If I go out to, say, December 19th, let's just say, I go out to December 19th, and we hit 75 in just 1 week, then let's do December 19th, okay? If we hit 70, well, okay, we'll do 65, 70. If we hit with just 1 week in, or 10 days in, we hit 75, how much am I gonna make over here? I'm not gonna make anything. I'm gonna make 7%. Okay, I'm gonna make 7%. It's gonna, and then I have to sit here in this trade and wait and wait and wait and wait in order. But what if at that time it rejects 75 again and retest 70 or retest 67? Then I'm looking at a loss and I have to wait and wait and wait and wait and wait. So on the debit spread, I do want to give myself less time. That way it just hits my target and I can either close the trade or there's just a little bit of time left before expiration, and so I could just wait it out and without risking it bouncing back down out of my max gain zone. Okay, so I'll save this one. Okay, and then I will pick one that is a little bit safer. It's like, where do I have strong support? Well, I know I have strong support actually right where we are at 70, but that's basically the trade that we did. So where else do I have strong support? I have strong support according to gamma at 67, right? We saw that 67 right here, okay? And then we also have our EMA 20 at 68, okay? So 67 or 68, I would be okay with that. So if we go over here and we do a 60, just call it 67, 68 spread. Okay, now I've got well, let's just make it a little bit safer, do 66, 67. That way we actually have a meaningful difference between the one we just did and this one, because when I did 67, 68, it's only a $5 difference. So 67, 68, we give ourselves a nice margin of safety. It can drop all the way down to 67, we'll still make maximum profit. 67 has the EMA 20 in the way at 68. So it would have to break that EMA 20 and it would have to break the support that we have in the form of a gamma pocket, a positive gamma pocket, a positive gamma exposure gamma pocket. So that's even different than a negative. So this was, where is it here? Yeah. So this bar, oh no, that bar is red. Never mind. I thought it was green. So in any case, I do have that support right there. And so the likelihood of us suffering a loss or going into the max loss zone is very, very low, or even to the break-even zone. Why can't I find there we go. So you see that break-even's down at 66.65. So for us to even just break even is already pretty unlikely because we have so much support between the price that we're at and that break-even point. So this makes this an even higher percentage probability trade, but of course the reward risk ratio is no longer 1-to-1, it's a little bit worse than 1-to-1, but still very compelling. 35 divided by 65 is over 50%. So calculator, 35 divided by 65, that's 53.85% versus what we thought that we could get from the single call. Our estimate was roughly 40%. So this still has the possibility of outperforming. Of course, if they go screaming through 75, then that single call will outperform. But at least according to our expectations, our expectation is that this debit spread is going to outperform that single call. Right? So I'll go ahead and save this. And I'm already 10 minutes over, but I will do the butterfly real fast. I'm going to choose the exact same expiration. We're going to do a long call butterfly. It will become a debit. We're going to center this at 75. Okay, and I'll see, I'm going to test different structures. So I want my break even to cover It'd be nice if it could cover the current price. It'd be nice. Okay, so we're at 69.78. Okay, so this is a 9 wide. So let's do 9 wide. Okay, we're at 69.78. This break even is at 68.75. That means it could go down a little bit and I will still make money. I like that. That gives me a little bit of margin of safety. And then it can go all the way up to 81.25 before I lose money, but that's not going to happen because once it hits the apex right here, if we hit 75 before expiration, I'm just going to close it. I'm not going to risk it, keep on going higher and breaking through and losing money on this side. So I actually don't have risk over here. I only have risk down here, unless it just gaps open super high, but the probability of that is super, super, super low. So so either we're going to close this out whenever it hits 75, or we're going to hold it to expiration, and wherever it is near 75, then that's where we'll make money. If we manage to pin it on the dot, if it hits exactly 75 on September 5th, then we stand to make $625 versus our max loss of $275. But look how big that break-even range is. As long as it's anywhere between 68.75 and 81.25, let me draw it over here. I'll draw it in purple. Sorry for going way over time today, guys, but I just want to finish this out so we have a complete lesson. So if we go 68.75 and then was it 81.25? Yeah, 81.25. Okay, so as long as we stay this would go to 75. This should be the 5th. Okay, right there. So basically this is the cone. 81.25. This purple line. Okay. That's it. As long as we're inside this range, we're going to make money. And what are the chances of it blowing out of there? It's not that high, right? Based on all of our belief and analysis that this is going up and not going down. And if it goes up, then once we hit 75, we're out. So we don't have any risk that's going to blow above here. Oh, sorry, we targeted the 75 gamma pocket. What am I doing? 81. This is wrong. This line is wrong. That's the one. That's what's confusing me. Okay, that line was wrong. Okay. Anyways, you guys get the idea, right? So as long as it ends up somewhere in here by September 5th, we're going to make money in this butterfly. Okay, so save that trade. And then I'm just going to follow this on paper. Okay, so this is not a recommendation that you guys do this, but we'll follow along on paper and we'll see how each one of these performs. Okay. All right, guys, I went way over time. Thanks for hanging in there with me. I hope you guys have a great rest of your day. If you have any questions, you can send me an email or you can ask them of me tomorrow. All right. Okay, guys, have a great rest of your day and I'll see you all tomorrow.